How to save money on taxes as a business owner. There is nothing quite like being surprised with a huge tax bill when you file your taxes. As a business owner, I get it. We are normally focused on growing our business, not paying taxes. Then, ironically, when we grow our business, taxes become a huge problem. And when your income grows to the point to where literally half of all of your income is going to taxes, then all of a sudden we have a tragedy on our hands, or at least that's what it feels like. But do you want to know what is worse than being surprised with a huge tax bill? Having a huge tax bill and feeling like you're paying way more than you actually have to pay. And this feeling is pretty common. A lot of taxpayers feel this way. And it's because it's actually a fact. Literally 90% of business owners pay more in taxes than they actually have to pay. And today I want to help you avoid being a victim to this problem by giving you the top 3 ways to reduce your taxes as a business owner. My name is Sherman the CPA, and I tax plan every single day for business owners, specifically at mycpacoach.com. I share my real world experience here on YouTube, and if you want to tag along for more ways to reduce your taxes, make sure you subscribe to our channel. With that said, let's go ahead and jump right in. All right, so most of my business clients come to me after paying a huge tax bill. I hear the same thing all of the time. Sherman, my heart sunk to my stomach when my accountant told me the amount of money I had to pay in taxes. They told me it was nothing I can do, and then I found one of your videos on YouTube, and then eventually they make their way to me. And literally 99% of the time, I find multiple ways to save them thousands in taxes by looking at 3 simple areas. So let's go ahead and talk about it. The number 1 way to reduce your taxes as a business owner is to find missing tax deductions. A lot of business owners are completely unaware of what they can or cannot deduct from their income, which is what your taxes are based on. But Section 162 of the tax code allows you to deduct almost any expense as long as it is ordinary and necessary for your trade or business. And because of this, a lot of business owners are able to convert a lot of their personal expenses into business expenses by meeting this simple criteria. If you can establish a business purpose for the expense, you can write off cars, travel expenses, meal expenses, home expenses, and so much more. Now, a lot of accountants are reluctant to write off these types of expenses, which makes no sense to me because the IRS has very clear guidelines and rules on how you can write off these expenses legally. All you have to do is meet the criteria of the rules, and then you can easily write off more of your income and pay way less money in taxes. And to add to this, there are ways to increase your tax write-offs even more by associating your family members or close friends with your business. Here's a simple example. So to write off a business meal, you must have the meal with a business contact. But if you already eat out a lot with a family member, like your spouse, for example, and they are associated with your business, then at that point, all you have to do is talk about business during that meal for it to be deductible. And boom, just like that, we just created a tax write-off from something you already pay for. There are similar creative ways to turn your personal vacations into business trips, your next car purchase into a business vehicle, a room in your house into a business office, and so much more. You just need to understand which rules you need to meet in order to qualify for those deductions and adjust your circumstances accordingly. And if your accountant does not strategize with you on things like this, then trust me, you are paying for it in taxes when you file your tax return. But that's just the beginning. There are even more ways to find missing tax deductions outside of converting personal expenses into business deductions. The most common way to miss business tax write-offs is to have poor bookkeeping. A strong bookkeeping system will easily track and record all of your business expenses so that you do not miss any business tax deductions. Ideally, your tax accountant is provided with a neat profit and loss statement that clearly shows your revenue, expenses, and remaining profit, which should be the only portion of your income you're taxed on. But I see a lot of business owners that fail to do any bookkeeping. which means it is unclear which expenses were actually incurred. And that ultimately leads to a bunch of missed tax deductions that could have saved them thousands of dollars in taxes. I once had a client who paid $100,000 more in taxes because he missed so many basic tax deductions. He had about $500,000 in business profit after expenses, which is what he should have paid tax on. But he ended up reporting his revenue of $1 million as his income because he had no way to track his tax deductions. To make it even worse, he did not have a business bank account, so he could not even look through his bank statements to clearly identify and show his business expenses. And then he used a lot of cash to pay for those expenses, which made it even more difficult for him to trace. It was a complete nightmare. And if you are a business owner with a lot of taxable income, you do not want to make simple mistakes like this that can easily cost you tens of thousands of dollars in extra taxes. So use a business bank account and put a strong bookkeeping system in place to avoid missing any valid deduction that you can use to reduce your taxes. Now let's move on to the second major way to save money on taxes: deferring your income into tax shelters. Once you've maximized your business tax deductions, the next way to save on taxes is to defer your income. This simply means that we are going to take income off of your tax return for this tax year and push it into tax shelters so you can pay less taxes today. This works great for individuals who have income in excess of what is needed to sustain their personal lifestyle expenses. So basically, if you don't need to spend more money in your business, and you don't need more money to sustain your personal lifestyle, then why pay tax on it? And that's the premise behind deferring your income. Now let's talk about how you can accomplish this. So you can shelter your income in various ways. If you like real estate, you can buy commercial or residential real estate, which can create a big tax deduction that you can use to offset a large portion of your income. If you want to put money aside for retirement, there are ways to put upwards to $300,000 in a single tax year with various retirement accounts and benefit plans that you can set up for your business. If you donate, well, you can set up a charitable account to set a large chunk of money aside to fund your future charitable giving, which would give you a big tax deduction today. Or if you're planning on having health expenses, you can put money aside in a health savings account to defer more of your income. And the list can go on and on from there. As a CPA, I like to take the things that my clients are genuinely interested in, and then I find the best ways to use those things to reduce their taxes. Some people only prefer to use real estate to save on taxes, while others may care more about retirement or donating to charity. And ultimately, this is why it's important to have a tax professional who can build a plan that is unique to your life and your circumstances. And if you need that, make sure you check out mycpacoach.com. Now let's move on to the third way to reduce your taxes: entity optimization. Now, your entity structure can significantly impact the amount of taxes you pay, but I put this point last for a reason. Now, I'll tell you why in just a second, but let's first talk about the benefits of optimizing your business entity. So different entities are taxed differently under the tax law, especially when it comes to a specific tax called self-employment tax. Now, self-employment tax is a 15.3% tax that every entity pays other than S corporations and C corporations. So naturally, a lot of business owners tend to favor switching to an S corp or a C corp to avoid a large chunk of this tax. But sometimes they do so unnecessarily, which is why I think this should be the last thing you should consider to reduce your taxes. And here's why. Since self-employment tax is based on your business income, you may not have much self-employment tax to actually pay if you do the first two things we talked about in this video very well. Or in other words, if you can reduce most of your taxable income through deductions and tax shelters, then changing your entity may not be necessary. Maintaining a corporation comes with additional rules, cost, and can even result in you paying more taxes if you do not know what you are doing. So make sure you educate yourself on all of these things before you change your entity and create a bigger problem for yourself in the future. And if you want to learn more about that, then be sure to subscribe to our channel because I already have in-depth videos on everything we talked about today, including entity creation. And by the way, if you want to get off YouTube and get a custom tax plan to save over $10,000 in taxes right now, then apply to work with me directly at mycpacoach.com. As always, thank you for watching, and I look forward to seeing you in the next episode.